Well, good afternoon, everybody. My name is Dacey, and on behalf of myself and Ed Cranford, my speaking companion today, we welcome you to this afternoon's A&A update for 2021. And Ed, I must say, this is a really good update. I'm really excited about this. How about yourself?
I'm super stoked by it.
You gotta love it. You gotta love it. No question about that. We decided to do something a little bit different this year. We are actually extending across several speakers throughout the firm, several subject matter experts. And the idea here is that we are trying to get a lot of concentrated focus on particular topics for this year's A&A update. We think the vocal variety will help make this a little bit more of a strong, entertaining session. And I guess with that said, Ed, any opening thoughts before we actually get started?
No, to kind of chime in with what you were saying, I think it will also break up the monotony of just hearing myself and you speak. As wonderful as we like to speak.
I think we are.
It'll break it up and hopefully keep it lively. So without further ado, I'm going to introduce Rhen, and he's going to speak about ASU 2020-06.
I am Rhen. I am a partner in the attest practice. I service life science technology companies as well as serve as the firm's subject matter expert in complex financial instruments, which is the topic of today's update. 2020-06 was part of FASB's simplification initiative, which has been ongoing for quite some time. The aim of that initiative and this ASU is to reduce unnecessary complexity in GAAP and generally simplify accounting for otherwise complex instruments. The ASU covers a number of different areas. We'll be talking about how it impacts convertible debt, convertible preferred stock, and other equity-linked instruments. The common theme among all those categories is that it has reduced the number of accounting models that we have to consider and reduces the overall complexity of the accounting conclusions. It also adds some disclosure requirements. So in cases where we are no longer recognizing some element of a financial instrument, we will have increased disclosure requirements around what the economic terms of that particular provision is. So it's sort of a fair trade-off between lesser number of actually recognized financial instruments with a little bit of an increased emphasis on disclosing all the relevant terms of those provisions. So first, the first major area that the ASU covers is convertible debt. What you see on screen right now is the convertible debt model before the adoption of 2020-06. You can see we had 5 separate models we had to consider when either recognizing or not recognizing a financial instrument or a component of that instrument. I want to run through these as sort of a refresher of where we started, then I can talk about how this was simplified or changed. Right? So the first model that we think about is ASC 480. This is the section on distinguishing liabilities from equity. It covers 3 broad categories of instruments. It covers mandatorily redeemable shares, which would be out of scope for a debt instrument. It covers stock settled debt, which is relevant, and it also covers certain puttable financial instruments, things like cash settled warrants. The next model would be recognition of a separate derivative financial instrument that gets bifurcated from the host debt instrument. This model is governed by a couple different sections of 815-15, which is the embedded derivative section. It also covers 815-40 for instruments that are potentially settled in the entity's own shares. Right? So the idea under this separate model for separate conversion features as derivatives is that certain settlement provisions need to be bifurcated and recorded separately as freestanding derivative instruments on the balance sheet. They're also subject to recurring fair value measures. The details of what gets bifurcated is, of course, beyond the scope of our 10-minute update here today. The third model we think about is conversion that's settled in cash or other assets. This is what we sometimes call the cash conversion guidance. This broadly applies to settlements where the value of the settlement is based upon the issuing company's equity, but yet it is settled in cash. and those instruments would get separately recognized between the debt component and the equity component. This is a model that we do see somewhat commonly in practice. The fourth model we think about is the conversion feature as a BCF, or a beneficial conversion feature. This is something we see very commonly in practice. It's where we consider whether the value of the equity settlement is in the money, whether it's beneficial on the date of commitment of the loan, which is generally the same day as the day the loan is funded, and to the extent that the conversion feature is, quote, beneficial, it is separately recorded as a component of stockholders' equity. And then the last model is debt that's issued at a substantial premium. We see this one much less commonly in practice, but there are situations where debt issued at a substantial premium, when none of the other four models apply, there can be a separately recorded component of additional paid-in capital. So again, separating the debt component from the equity component. The models 2 through 5 above generally result in debt discounts that are recorded on day one. The impact of the debt discount is that it results in additional non-cash interest being recorded. The FASB, when they got the feedback from issuers and others in practice, the feedback they got was that the most relevant measure of debt instruments cost is the cash interest, the stated interest rate. So they looked at reducing the number of models, which we can see in the next slide. We're going to be eliminating 2 of those models, right? So the first one that's eliminated is the cash conversion guidance, right? So after the adoption of ASU 2020-06, the cash conversion guidance is no longer going to be available to be recognized, thereby reducing the overall number of considerations we have to make. The second piece that was eliminated is the beneficial conversion feature guidance. Again, this very commonly resulted in debt discounts. It resulted in non-cash interest charges being recorded over the life of the loan. And because the FASB had an increased emphasis on cash-based and stated interest rates, they eliminated this particular accounting consideration. The other elements of the legacy models do continue to apply. 480 and the bifurcation tests under 815 remain intact, except for a couple modifications I'll speak of in a minute. And lastly, the debt issued at a substantial premium, that model is also retained. We had some similar updates for convertible stock. So again, the idea is that they were looking to reduce complexity in the accounting for convertible instruments. The models here are a little bit different. The considerations of 480, the overall framework is the same, but in the context of convertible stock, we're looking mostly at instruments that are mandatorily redeemable. Next, we would consider if there are separate embedded derivatives that require bifurcation and separate recognition. And then finally, similar to convertible debt, we also consider whether or not a conversion feature inside a preferred stock instrument is also beneficial. That would result in a separately recognized component of additional paid-in capital separate from the preferred stock itself. So under the new framework, the first 2 elements have been retained. 480 is intact. The bifurcation test is largely intact, and I'll speak to some differences here in a moment. But the third criteria, the BCF guidance, just like under convertible debt, it has been eliminated for convertible preferred stock. So disclosure requirements, they just clarified some disclosure requirements. The things we have listed here are things that we generally would have always been disclosing, such as information about the terms and features of the convertible debt. Basically, you disclose the relevant facts and mechanics of how the instrument works. A disclosure about how the instruments are presented on the balance sheet. If not obvious, this also would have been commonly disclosed previously. And then here's where it gets a little bit different. Information about events, conditions, and circumstances that can affect the amount and timing of future cash flows related to the convertible instruments. We largely would have covered this in practice under the previous model. However, because we're no longer recognizing all of the features, they just wanted to make sure we had robust disclosure around for the economic economics of the note or of the preferred stock to make sure the readers understand how it works. Then they kind of consolidated and centralized those disclosure requirements within 470-20 and 505-10. So they also modified some of the guidance on equity-linked instruments. So at a very high level, we think about these conditions for equity-linked instrument when we're determining whether or not they qualify for equity classification in the context of step 2 of the indexation guidance. So if you need more information about indexation guidance and the scope exceptions for instruments that are indexed to the company's own stock and classified in stockholders' equity, we can follow up offline, as some of those details are well beyond the scope of our very short update today. So basically what they did was they removed and clarified some of the previously existing requirements for equity classification. The first one they removed is a requirement that the settlement has to be permitted in unregistered shares. So this was problematic in practice because it required that accountants and issuers kind of weigh in on the legal process around issuing registered or unregistered shares to settle an equity-linked instrument, in this case, a convertible debt instrument or a piece of convertible stock. So that provision has been removed. They also removed requirements that the holder cannot have rights that are higher than or better than other shareholders of their class, and it removed a requirement that there cannot be collateral requirements related to the conversion feature. And then finally, they required and they clarified that how cash repayments or how cash payments upon failure to timely file with the SEC impact the overall classification conclusion. They just clarified some diversity in practice on that topic. They did retain the requirement that the entity have sufficient number of authorized shares to settle the conversion feature, and they retained the provision that the contract contained an explicit limit on the number of shares that can be issued upon settlement. And they also retained the requirement that there cannot be a cash settled top off or make whole feature. So there are impacts on earnings per share. I won't go into these in a great amount of detail, but they just sort of clarified how the application of 2020-06 would apply. Because we're no longer recognizing some features, they clarified that we should still be using the if converted method for all convertible instruments, and we should presume stock settlement of all convertible instruments when determining the dilutive earnings per share calculation. So effective dates for 2020-06 for public companies, fiscal years and interim periods beginning after December 15, 2021. So basically 2022. For all others, it's effectively for 2024 calendar years. Transition, we're allowed to do either a modified or a full retrospective adoption. I thought interestingly, they're allowing the fair value option to be elected upon adoption. So if for some reason you're seeing this adoption as increasing complexity for your particular fact pattern, you do have the choice to go back and take the fair value option, which would simplify some of the considerations that we just talked about. As for early adoption, so early adoption is permitted beginning after December 15, 2020. However, in this particular case, we can only adopt at the beginning of a fiscal year, right? So no mid-year adoption. So this is something we should consider as we get into the 2022 calendar year. Think about whether or not it's something you want to early adopt as a private company and what that might look like for your clients. Which brings me to the end of my update on 2020-06. The idea again was to reduce complexity around the accounting for some of the more sophisticated financial instruments. We'll see if that plays out in practice, if it actually does reduce complexity. I tend to think it will, especially when you consider that it eliminates the entirety of the beneficial conversion feature guidance. That is something that many of our clients have put considerable effort into complying with. So if you have any questions, you can follow up with me through the quality control process or myself directly. Thank you.
And thank you, Jarrod, for that really insightful presentation. We certainly appreciate it. And you always give us something to think about. There's no question about that. Keeping the party moving along, let's move over to Lisa Galinsky, who's also in our technical resource group, as Lisa speaks about ASU 2020-07, presentation and disclosure for not-for-profit entities for contributed non-financial assets. Take it away, Lisa.
In September 2020, FASB issued ASU 2020-07, which contains new presentation and disclosure requirements for contributed non-financial assets, which is referred to by many people as gifts in kind. ASU 2020-07 was issued with the intent to make the reporting of contributions of non-financial assets more transparent in a not-for-profit entity's financial statements through enhanced disclosure. Transparency is important because many not-for-profits receive and use many different types of non-financial assets in their programs and activities, and non-financial assets can significantly affect key metrics used by grantors, donors, watchdog agencies, and others. This ASU didn't change any of the accounting rules related to contributions and non-financial assets. It only changed how contributions and non-financial assets are presented in the financial statements and disclosed in the notes. The definition of a non-financial asset is an asset that is not a financial asset. Financial assets consist of cash or a contractual right to receive cash. Non-financial assets include land, buildings, equipment, use of facilities, equipment or utilities, materials and supplies, intangible assets or services. For services, these would be services that meet the criteria for recognition as contribution income, which is they create or enhance assets that are not financial in nature or require specialized skills or provided by individuals with those skills and would typically need to be purchased if the services had not been donated. Common types of donated services that meet this criteria include architects, teachers, lawyers, accountants, doctors, and construction services. The ASU is effective for annual periods beginning after June 15, 2021, and for interim periods within fiscal years beginning after June 15, 2022, which means it's effective starting with fiscal years ending on June 30th, 2022, and interim periods starting in fiscal years ending on June 30th, 2023. Early adoption is permitted. When this ASU is adopted, it must be adopted on a retrospective basis because the FASB believes it's important for trending information to be comparable. The ASU has both presentation and disclosure requirements. The presentation requirement is to show contributed non-financial assets as a separate line item in the statement of activities. Showing the breakout between financial and non-financial contributions in the note disclosure is not allowed. Also, if the financial statement is comparative, if the prior year didn't have contributed non-financial assets on a separate line, then the prior year's statement of activities will need to be reclassified. The ASU requires a quantitative disclosure of the amount of contributed non-financial assets received by category. The ASU also requires qualitative disclosures for each of the categories. These disclosures include information about whether the assets were monetized or utilized during the reporting period. If the assets were used, then you need a description of the programs or other activities in which the assets were utilized. If the not-for-profit has a policy regarding monetizing contributed non-financial assets, the policy has to be disclosed. If the entity doesn't have a monetization policy, you aren't required to disclose the fact that there is no policy. If there were any restrictions placed on the use of the non-financial assets received, the donor-imposed restrictions are required to be disclosed. The ASU also requires the disclosure of the valuation techniques and inputs used to arrive at fair value measurement and initial recognition. And if the market used to determine the fair value is a market in which the entity is prohibited by donor restriction from selling or using the non-financial asset, the entity must disclose the market used. Here is an example of a statement of activities. The line that is crossed out is the presentation as required under current GAAP and has been superseded by ASU 2020-07. The lines that are underlined are the required presentation under ASU 2020-07. Please note that this is just an example, and you don't have to use the exact wording. You just have to use wording that means the same thing. Just make sure that at a minimum, you have the presentation of the contributions of financial assets and non-financial assets on separate lines. There is no required format for the disclosures. You just need to make sure all the required elements are disclosed. If this ASU is relevant to you, starting on this slide are sample disclosures that you can review at a later date. I have provided 2 format examples. Slide numbers 7 through 9 are the first format option with the qualitative disclosures in narrative format, and slide numbers 10 through 12 are the second format option with the entire disclosure in tabular format.
Thanks, Lisa. Now, I'm going to throw it over to Dave so he can talk about reference rate reform.
Well, thank you very much for doing that. Already introduced myself as, I'm the partner in charge of our technical resource group at Withum, Smith & Brown. And this next topic that we're going to talk about, we'll discuss 2 recently issued ASUs, ASU 2020-01 or 2021-01 and 2020-04. And this provides a level of accounting relief in connection with reference rate reform. And I'm going to get into what that means in just a second, but it is covered by topic 848. Let's go to the next slide. What exactly is reference rate reform? It deals with the elimination of LIBOR and IBOR. So we all know that LIBOR is the London Interbank benchmark rate that's used by thousands and thousands of debt transactions. It's the most widely used short-term interest rate benchmark in the world. And there's upwards of $300 trillion in mortgages, consumer loans, and corporate debt and derivatives that all use LIBOR as a benchmark. The interesting thing about LIBOR is it's going to go away. And I'm going to provide you some background as to why that's the case. It's ultimately going to be replaced by a new acronym called SOFR, Secured Overnight Funding Rate, which deals with the U.S. benchmark for debt securities and repurchase agreements for T-bills. So with that said, we're going to go over to the next slide, and let's discuss why there is a move away from LIBOR to this new benchmark rate called SOFR. So LIBOR has been around for quite some time. It's been around for decades. But since 2008, the number of banks that dealt with the concept of LIBOR has shrunk to the point where the benchmark rate for LIBOR used to be transaction based on the number of transactions that occurred. However, now it's more based on a subject matter expert's perspective as to what the interest rate should be for a particular day, i.e. the panel banks that make that determination. And they make that determination every day at 11:45 a.m. London time. So as a result, LIBOR is now based more on expert judgment than it is based on actual daily transactions. If you compare that with SOFR was established in 2018, and it's based on the U.S. Treasury repo market. So there's all kinds of entities out there that buy and sell U.S. Treasuries. If an entity sells a U.S. Treasury on the repo market, they buy it back at the following day at a slightly incremental amount. That incremental amount essentially represents interest, and it's a more transaction-based way of determining what a good benchmark interest rate is for all of those securities that have historically used LIBOR. If we go to the next slide, the FASB had to come up with a reaction to LIBOR. So what was the reaction? They came out with 2020-04. Now, what's interesting about this is ASU 2020-04 was issued in March of 2020, and that date does have some significance. I'm going to get into why in just a second. Essentially, what the FASB guidance does is it provides the concept of these optional expedients that allow for exceptions to GAAP for a transition from one interest rate to another interest rate, i.e. the ceasing of LIBOR and the adoption of a replacement benchmark rate for the debt instruments and all the various instruments that are indexed to those rates. So we're gonna get into some examples of how that comes into play on the next slide. So as we look at the next slide, if you look at the expedients that are available under 2020-04, we have contract modifications, and they're handled prospectively as a rate adjustment. Under current accounting, when there is a change in terms to a debt instrument, there needs to be a measurement in order to determine whether that debt instrument results in debt extinguishment accounting, where there's a gain or a loss on the extinguishment of the debt that's run through the P&L, or is it an interest rate adjustment that's just handled prospectively on a going forward basis with the revised interest rate. The debt extinguishment aspect of it can take some time, and there's a lot of calculation that goes into that. If there's over like a 10% change in cash flows, for example, then there would be deemed to be debt extinguishment. What this reference rate reform ASU says is you don't have to do that. You can just accept the new interest rate, change the interest rate on a going forward basis, and move on. So there's a simplification aspect to it. If you look at lease modifications, it's the same kind of concept. If an interest rate changes in a lease modification, that might result in a whole new lease, but you get that relief under ASU 2020-04. And there's also modifications that deal with the reassessment of whether a derivative is hedge effective or whether there's accounting ramifications associated with a derivative. If you think about that, under derivative accounting, if there's a change in terms of an underlying that goes into a derivative contract, that change in terms would trigger ineffectiveness with respect to the original hedging instrument if you're doing qualified hedge accounting. This ASU gives relief for that, and it says you can that's not considered to be a critical term change just because you change from LIBOR to another acceptable reference rate. So if we go to the next slide, ASU 2021-01 is essentially the same concept as 2020-04, except it takes a deeper dive on derivatives. So the thing to keep in mind here as it relates to both of these ASUs is if you look at the effective date was for any derivatives entered into or any changes in terms entered into from March 12, 2020, and it's supposed to expire December 31, 2022. That's what's originally contemplated in both of these ASUs. The second ASU, 2021-01, was entered into in January of 2021. However, in March of 2021, London announced that LIBOR is going to be around until 2023. As a direct result of that, I think you're going to see another ASU come out that extends this date about how often you can use this reference rate reform practical expedients past 2022, because I think it's going to be necessitated by the fact that LIBOR is not going to be completely wound up as of the end of 2021. It's going to go into 2023. So stay tuned for another reference rate reform amendment. It just hasn't happened yet, but I think it's going to. And if we go to the next slide, the effective dates for this, it's for all entities as of March 12, 2020, currently through December 31 of 2022. That effective date was designed around the fact that we thought LIBOR would be completely gone by the end of 2021, so kind of gave a year to wrap it up. That's no longer the case, so I think you're going to see another reference rate reform ASU come out, and you can see the rest of the effective dates. So that's really both of these ASUs on reference rate reform in a nutshell. So with that, let me turn it back over to Ed.
Thanks, Dave. Next, we've got Christina Flynn teed up to talk about ASU 2021-02, franchisers.
Hello, and welcome to our brief discussion of ASU 2021-02, franchisors, revenue from contracts with customers. My name is Christina Flynn, and I am a quality control principal in our technical resources department. ASU 2021-02 was released as a result of concerns raised over the cost and complexity of applying Topic 606, revenue from contracts with customers, as it relates to franchisors as a party to a written franchise agreement. Franchise agreements typically have a number of provisions, including granting of franchise license, activities to get the franchise up and running, and continued services. Prior to adoption of Topic 606, the initial franchise fee, which is most often received as a lump sum payment, was recognized as revenue when the franchise location opened. Under the new revenue guidance, franchisors must determine if pre-opening activities constitute a separate performance obligation and analyze the standalone selling price. Prior to release of this ASU, there was disparity in the application of the identification of performance obligations step under Topic 606, as some constituents determined that the pre-opening services were not distinct and therefore satisfied over the license term, while others were identifying it as distinct and recognizing revenue upfront. Since the goal of Topic 606 is to provide users of financial statements with more transparency, consistency, and comparability, the practical expedient outlined in this ASU simplifies the identification of performance obligations step. This new practical expedient only applies to non-public franchisors. The practical expedient only applies to the identification of performance obligations and not the allocation of standalone selling prices. Once adopted, this must be applied consistently to contracts with similar characteristics and circumstances. The practical expedient only applies to pre-opening services and allows them to be treated as a single performance obligation, distinct from the franchise license. The practical expedient applies to a predefined list of services. These services outlined in ASC 952-606-25-2 are assistance in selection of a site, assistance in obtaining facilities and preparing the facilities for their intended use, including related financing, architectural and engineering services, and lease negotiation, training of the franchisee's personnel or the franchisee, preparation and distribution of manuals and similar material concerning operations, administration, and record keeping, bookkeeping information, technology, and advisory services, including setting up the franchisee's records and advising the franchisee about income, real estate, and other taxes, and inspection, testing, and other quality control programs. The franchisor must disclose the adoption of the practical expedient and accounting policy to treat pre-opening services as a single performance obligation. How this will be applied is dependent on whether or not Topic 606 has been adopted and how. If Topic 606 has not been adopted, the adoption of this practical expedient would follow how the franchisor intends on adopting Topic 606, either on a modified retrospective or full retrospective basis. If Topic 606 has been adopted, then the practical expedient would be applied retrospectively to when Topic 606 was originally adopted. Thank you for your time today, and I hope you have a great day.
Well, thanks, Christina. I appreciate that insightful couple of minutes on that topic. Let's now go over to Kristin Fee, who also works in our technical resource group. And Kristin's going to talk about ASU 2021-03, Intangibles, Accounting Alternatives for Evaluating Triggering Events. And I'm just getting the chills thinking about that, Ed. So let's go to Kristin.
Hello, thank you for joining me today. My name is Kristin Fee, and today we are going to discuss ASU 2021-03, Intangibles, Accounting Alternatives for Evaluating Triggering Events. Today's agenda includes ASU 2021-03, Intangibles, Goodwill, and Other, Topic 350, Accounting Alternatives for Evaluating Triggering Events, the effective date, 2021-03, when to test for impairment, and what is a triggering event. So let's begin. In December of 2020, the FASB proposed Accounting Standards Update Intangibles, Goodwill, and Other, Topic 350 for public comment, and comments were due January 20th, 2021. The reason for the proposed update was because there was expressed concern from stakeholders that it was cost and complex for private companies to evaluate triggering events and potentially measuring goodwill impairment during the reporting period. The ASU simplifies the goodwill impairment triggering event by allowing private companies and not-for-profit entities as well to perform goodwill impairment triggering event evaluation as of the end of the reporting period. The issue became really apparent during COVID-2019 pandemic because of the uncertainty in the economic environment and the significant changes in facts and circumstances quarter over quarter. So as you know, additionally, most private companies do perform their analysis as part of their annual financial reporting process. So it was becoming more difficult for them to determine the triggering date because they were going back in time to figure out when that happened while they were doing their annual reporting evaluation. The feedback was positive from both the private company council as well as other respondents, and the ASU was issued in March of 2021. The amendment is effective prospectively for periods ending on or after December 31st, 2019. Early adoption is permitted for both interim and annual financial statements that have not been issued or made available for issuance as of March 30th, 2021. So now let's discuss the differences between current GAAP and the accounting alternative. Under current GAAP, when a triggering event occurs, it is more likely than not that the fair value of a reporting unit is less than the carrying amount. If it is more likely than not that the goodwill is impaired, it must test for goodwill impairment using the triggering event date as the measurement date. Under the accounting alternative, an election by the entity not to monitor goodwill impairment triggering event testing during the reporting period and instead to evaluate the facts and circumstances as of the end of the reporting period to determine if it is more likely than not that goodwill is impaired. The accounting alternative should reduce costs and complexity for preparers by aligning the triggering event evaluation date with the reporting period end date. The adoption does not affect any other aspects of subsequent event monitoring or measurement of goodwill or the evaluation of triggering events. An entity will assess qualitative factors to determine if it is necessary to perform the goodwill impairment test. If the entity does determine that it was more likely than not, 50% is considered more likely than not, that the carrying value of the goodwill is less than the carrying amount, the quantitative goodwill impairment test should be performed. So now let's just touch upon some triggering events that you might consider. I mentioned earlier about COVID-19, and some of these factors here certainly will have been impacted because of the pandemic. You might want to consider things such as deterioration in general economic conditions. Did you have a limitation in assessing capital? If you were subject to foreign current exchange rates, that may also have an impact on your goodwill impairment testing, or that will also determine if it's a triggering event. Industry and market conditions, if there was a decline in your market for an entity's products or services or regulatory or political and development. Cost factors, such as increased raw materials, labor, or other costs that could have a negative impact on earnings. Negative or declining cash flows or decline in actual or planned revenue or earnings. So some of those are just some factors that you might consider if you had any of those such would be considered a triggering event. So in conclusion, whether entities report on an interim or annual only basis, entities electing the amendment are not required to monitor the triggering events throughout the reporting period. Instead, the entity should assess the facts and circumstances as of the end of the reporting period to determine whether there has been a triggering event and whether it is more likely than not that goodwill has been impaired. So I thank you and have a good day.
Well, thanks, Kristin. That was appreciated. Next, we have Dave Katz. He is also a member of our technical resource group. He's going to speak about ASU 2021-04, EPS, debt modifications and extinguishments, stock compensation, derivatives, and hedging. Sounds like a good time.
Hi, I'm Dave Katz, principal in Withum's Technical Resource Group, and today I'm going to cover ASU 2021-04, which deals with the modification of equity classified written call options. So thanks for joining me today. I look forward to presenting this to you. So ASU 2021-04, I unfortunately feel obligated to note the official name here, so bear with me for a second. It's Accounting Standards Update 2021-04, Earnings Per Share, Topic 260, Debt Modifications and Extinguishments, which is subtopic 470-50, Compensation, Stock Compensation, which is topic 718, and Derivatives and Hedging, Contracts in Entities' Own Equity, which is subtopic 815-40, and it's the issuer's accounting for certain modifications or exchanges of freestanding equity classified written call options, a consensus of the FASB Emerging Issues Task Force. A lot to say there. So it's going to relate to how a company should treat modifications to equity classified written call options. So as you can see, it touches a few different areas here. There's compensation, stock compensation, there's debt, there's derivatives. So, we'll get into a little bit of how they all marry with each other. Typical instrument that this would apply to is a warrant to purchase the company's common stock, but I'll use the term instrument throughout the presentation here just to keep it consistent. And the general idea here was there was some diversity in practice when a freestanding equity classified instrument was modified or exchanged, as the codification lacked explicit guidance on that type of transaction. So what you'd see is that some companies would book a dividend while other companies would book it as an expense, and this guidance is intended to eliminate that sort of diversity. Pronouncements effective for all entities for fiscal years beginning after December 15th, 2021, including interim periods within those fiscal years. The amendments should be applied prospectively to modification or exchanges occurring on or after the effective date of the pronouncement. And the transition disclosure should be consistent with the guidance within ASC 250 for accounting changes, except for the effect of adoption on the financial statement line items, including EPS. Early adoption is permitted, including adoption in an interim period. But should a company elect to adopt in an interim period, the guidance should be applied as of the beginning of the fiscal year that includes that interim period. And I just want to reiterate that point because it's a little different. So for an example, if you're adopting in Q2 of 2022, you would go back to January 1st of 2022 when applying the new guidance. And the one other thing I want to point out here is that the board ultimately narrowed the scope of the final guidance to modifications of exchanges of equity classified freestanding written call options that remain equity classified. So this does not apply to all equity classified freestanding forwards and options. So something like a forward contract or option on an entity's own shares would not be applied here. The new guidance requires the company to treat a modification of an equity classified instrument like a warrant that does not cause that instrument to now become liability classified as an exchange of the original instrument for a new instrument. And that's regardless of whether that modification structured and or written as an amendment to the terms and conditions of the original instrument or as a termination of the original instrument and issuance of a new one. So it doesn't matter which one that is, you're going to treat it as a modification, and you're going to treat it as an exchange of the original instrument for a new instrument. And then from there, as you would do under existing GAAP, you would measure the effect of the modification as the difference between the fair value of the modified instrument and the fair value of the original instrument immediately before modification. And that's something you may have seen, in stock option exchanges. And unless that instrument were publicly trading in an active market, you would typically do this using a valuation technique, maybe a Black-Scholes model, maybe a binomial model. And then also noted in the ASU's consideration the overall nature of the transaction. If there's more than one element in the transaction, such as if the modification includes a debt modification and an equity issuance, then you would allocate the effect to each element. And likewise, if an instrument is modified in connection with the issuance of debt, the company would recognize the increase but not any decrease in the instrument's fair value as a debt discount if such instruments are held by the lender, or as a debt issuance cost if the instruments are held by a third party, and then record them under ASC 835 in determining the effective interest rate of the new debt. So on the debt modification side, the company needs to consider whether the modification of the instrument is related to or at least part of an existing debt's modification under the topics in ASC 470. So if so, then the accounting is based on whether the instrument is held by a creditor or a third party. In this case, if held by a creditor, the company would record the instrument's change in fair value as a fee paid or received, and would include that difference in the instrument's fair value when calculating the effective borrowing rate of the new debt. So this would be used in assessing whether a concession is granted under ASC 470-60, and if within the scope of ASC 470-50 for debt modifications and extinguishments, and applying the 10% test to determine whether there is a substantial modification, and that would trigger the related accounting. If such debt is held by a third party, then like I mentioned previously, increase in the fair value would be treated as a third party cost, while a decrease would be disregarded. And then in instances where the modification is not related to an equity issuance and new debt or debt modification, the increase in fair value of the instrument would be treated as a deemed dividend. So I'll add the caveat here that that's unless the modification is within the scope of another topic within the codification. And should there be any decrease, you would again disregard it. And just to give a couple of examples of when it may be under a different topic, you think about if it relates to a transaction with the customer, you would likely fall under ASC 606 for revenue from contracts with customers, or if it relates to a compensation arrangement, you would likely fall under ASC 718 for stock compensation. But overall, the guidance is pretty clear that if it's not related to compensation or financing, the modification should be based on its substance, both stated and unstated. So just go through, the related event with the modification and impact, just to kind of summarize what I mentioned. Both debt and equity, you would allocate to the respective elements of the transaction. If it's to raise debt, it's a debt issuance cost. If it's a financing transaction to raise equity, it's increase in fair values and equity issuance costs. Modification of debt, where the warrant is held by the creditor, accounted for as fees between the debtor and creditor. Where the warrant is held by a third party, increase but not a decrease is accounted for as a third party cost. And then modification of debt, when evaluating a troubled debt restructuring, the increase or decrease is included in determining the effective borrowing rate and applying that 10% cash flow test. And then other modifications, the increase is a dividend. So just quickly here on the EPS side, the company would deduct the effect of a warrant modification recognized as a deemed dividend in computing income or loss available to common stockholders as part of the basic EPS calculation. So you have an EPS effect there as well. And you could see that, in a multiple element transaction, the effect of the modification should be allocated to the respective elements of the transaction. So lots to unpack here. For some, the guidance as written, it was already adhered to by the company, but for others, you may see some new accounting. But certainly either way, you'll see less diversity in practice, which to me is always a good thing. So thank you for joining me today, and that's all.
Hello, everyone, and welcome to the most exciting session of the day. Okay, yeah, I don't believe it either. Anyway, I am here to discuss a pronouncement that came out this year regarding leases. For those of you who don't know me, my name is Erdmann, and I'm the lease guy for 842. I'm out of the New York office. And earlier this year, the FASB came out with ASU 2021-05, dealing with lessors that have leases with variable payments. And we'll talk about the issues. So what was wrong? So in ASC 842, as they drafted it, leases were required to be classified as finance leases if the certain criteria were met. We're all familiar with the 5 tests. It was previously 4. They've added a 5th one, but they're all substantially the same. But ASC 842 also mandates that variable lease payments that are not based on an index or rate are excluded from the lease receivable calculation. Okay, 2 important factors are working together. So who cares? Well, the net investment in the lease may be less than the carrying amount of the leased asset, resulting in a day 1 loss on the lease. Okay, think about that. We have to measure the present value of all the fixed payments, and if the lease is largely based on variable payments, that number will end up being very low. Okay, and so low it may be even less than the carrying amount, or essentially the cost of the underlying asset. And under finance lease accounting, there would be a day 1 loss to recognize. Subsequently, the future variable payments would be recognized in income as earned, rather than just a collection of the receivable, which creates a disproportionate recognition of income and loss over the lease term, which is really not what we're looking for. That does not represent the economics of the deal or the arrangement. And a lot of users have seen this and went back to the FASB to advise them of that. So what's the fix? ASC 842, as amended by ASU 2021-05, will now require lessors to classify leases that have variable lease payments that don't depend on an index or rate as operating leases, okay, if the lease would have been classified as a finance lease, and such classification would result in a day 1 loss. Okay, that's the important thing. Must satisfy both. Okay, so this ASU does not eliminate finance leases. It just is meant to remove leases that were trapped in recognizing day 1 losses due to the variable payment exclusion criteria. It wasn't contemplated when they first went through this. So again, for all leases that are subject to this new amendment, the lessor has to classify them as operating leases if they would have been a finance lease, but also result in a day 1 loss. Okay, if there is a day 1 gain, which is sort of your normal lease, if you will, those are fine. They will remain finance leases. Only those that are stuck with recognizing a day 1 loss due to variable lease payments not being included will now be required to be accounted for as operating leases. Again, this one is not an election. It is a requirement to treat them as operating leases if these 2 criteria are met. Okay, as far as implementation, this is effective for all entities, okay? No differentiation here. All entities for annual periods beginning after December 15th, 21, which is calendar 22. But for interim periods, it is for public entities within years beginning after December 21. Non-public entities are only required to implement for interim periods beginning after December 22 or calendar 23. So in essence, for the non-public companies, they get an extra year to implement on an interim basis, basically giving them the first year to get up to speed for their annual reporting. But public companies have to do it right away for Q1 22. In transition, okay, if the entity has already adopted 842, you have a choice. You can do it retrospectively for any leases that were commenced or modified post the adoption of 842, or you can do it prospectively for any leases that are commenced or modified after the ASU 2021-05 adoption date discussed on a previous slide. Okay, so if you've already adopted, you have a choice. You can go backwards or just go forward. And naturally, if you have not yet adopted 842, you will just follow the 842 transition rules once you implement 842. Okay, so small change, but significant change. Again, for lessors that have leases with variable payments, you may need to qualify them as operating leases if you would result in a day one loss due to variable payments. Okay, as usual, any questions, feel free to reach out to me. Otherwise, have a great day.
And thanks, Al. I certainly appreciate that insightful moment as it relates to that ASU. And now let me turn it over to my partner in crime, Mr. Ed Cranford, as he talks about agreed upon procedures and ATC 215. Take it away, Ed.
All right, thanks, Dave. So I'm going to kind of give a refresher on agreed upon procedures, but there were some standards that did change. So it's going to be a little bit of a refresher and then going over the changes that happened. So agreed upon procedures are engagements where a CPA is report findings based on specific procedures performed. So we can perform specific procedures on financial or non-financial subject matter or on an assertion and report the findings without providing any kind of opinion or conclusion. So I always kind of equated to, we were asked to do things, we do things, and we report what we found. I mean, it's as simple as that. There are some kind of rules that we have to follow. The procedures performed should be specific and not include vague or ambiguous language. We need to be very specific about what we were asked to do and what we did. Findings are the factual results of the procedures performed. They should be objectively verified and described and should avoid vague or ambiguous language. All AUP engagements have an engaging party who hires the practitioner, a responsible party who is responsible for the subject matter, the practitioner, and the intended users. So on the next slide, I've kind of given some examples of good and bad AUP procedures. Appropriate procedures are procedures that are characterized by a specific action, something that you can point to and say that you did. Like the CPA inspects a document, they confirm a document, they agree from one document to another, they trace and recalculate. The converse of that, the inappropriate procedure, is a procedure defined with vague or ambiguous language, such as we evaluated the specific topic, we interpreted it, we examined it. When you say you examined it, well, what exactly did you do? Did you just look at it? Or inspection and confirmation are much better terms to use, much more specific. The second example of an appropriate procedure would be the comparison of documents, schedules, or analyses with specified attributes. The inappropriate procedure would be mere reading of work performed by others to describe the findings. An appropriate procedure would be confirmation of specific information with third parties. Inappropriate procedures would basically be evaluate the competency or objectivity of another party. Well, that's really hard to do, when you're trying to actually specifically look at something. You can't evaluate a competency of someone. And the last appropriate procedure, not the last one, but the last one on this slide, is the performance of mathematical computations. The next slide gives examples of appropriate finding descriptions, inappropriate finding descriptions. And again, these are all examples, and then we'll go over what we can report upon and what we can't on the next slide. But an appropriate finding description is no shipment dates shown on the sample of shipping documents were after June 30, 2021. That's verifiable. Somebody can look at that and somebody can reperform that. The inappropriate finding description would be nothing came to my attention as a result of applying the procedure. Well, that's kind of vague. The next one talks about the number of blocks of streets paved in the chart of performance statistics was 3 blocks more than the number calculated from the contractor's certificates of project completion. The inappropriate finding on this one would be the number of blocks of streets paved approximated the number of blocks included. Well, approximated isn't specific enough. And then the last appropriate finding description, all classification codes inspected and the identified documents were the same as those shown in the computer printout except for the following, and he lists specific exceptions. The inappropriate finding descriptions, all classification codes appeared to comply with such performance documents. Again, what does that mean? So that's not giving the user very much comfort there. Next slide. So the benefits in the AUP engagement. AUP engagements can be tailored to the client's specific needs as the procedures can be chosen based on only what is considered necessary. They can target specific financial data such as AP, AR, or related party transactions. They can cover non-financial information such as internal controls or compliance with contractual agreements. They may even cover specific financial statements. They're flexible because they can be performed at any time of the year and can cover any time period. As the client can choose only the procedures considered necessary, the AUP engagement can be cost-effective compared to other engagement types. Next slide. So AUPs have been around for quite some time, but their standards have just recently been changed by SSA 19. It's effective for all reports dated on or after July 15, 2021, so the standard is currently effective. And the changes actually provide a greater amount of flexibility to practitioners in performing the AUP engagements. And on the next slide, I'll kind of explain why it gives us a little bit more flexibility. So what changed? The new standard no longer requires the practitioner to request an assertion from the responsible party. So we don't have to get something from the client saying, this is what we assert. It permits the development of procedures during the course of the engagement and allows practitioners to develop or help develop these procedures as part of the AUP engagement. Previous to this new standard, we would have to agree in advance on what procedures we would perform. And during the course of the engagement, sometimes it would be discovered that we probably should have done a different procedure or done an additional procedure. So this change actually allows us to be a little bit more flexible in our performing the engagement. And it also allows us to help the client to develop the test that they may need. The new standard no longer requires intended users to take responsibility for the sufficiency of the procedures. The engaging party acknowledges that the appropriateness of the procedures performed for the intended purpose of the engagement before the practitioner issues the report. And it also, this is a new twist too, it permits the practitioner to issue a general use report, which basically means it can be distributed publicly. But it does not prohibit the issuance of a restricted use report when the practitioner deems the restriction is appropriate. The next slide. So the AUP report has changed quite a bit too, the actual report that we submit to the client once we're all done. So the new AUP report should do the following. It should identify the engaging or responsible parties and the subject matter, state that the engaging party acknowledges that the procedures performed are appropriate to meet the intended purpose of the engagement. It will also state that the practitioner's report will not be suitable for any other purpose. State that the procedures performed may not address all items of interest to a report user and may not meet the needs of all report users. All reports should describe the procedures performed and describe the findings for each procedure performed. It would state that the petitioner was not engaged to and did not conduct an examination or review, which would result in the expression of an opinion or a conclusion. Again, it's important to say that an agreed upon procedures engagement does not, we are not giving an opinion. We're simply just saying that we were engaged to do something, we did it, and here are the results. The report should also state that the practitioner does not express an opinion or conclusion, and we also have to state that we are required to be independent of the responsible party and required to meet the practitioner's other ethical responsibilities. And I do believe that is the last slide. So with that, I'm going to kick it back over to Dave so he can talk about direct examination engagements, ATC 206.
Well, thanks, Ed. I certainly appreciate that, and great job on that discussion on agreed upon procedures. And it's interesting. We don't normally on a client CPE spend a lot of time talking about different types of attestation engagements. But I think agreed upon procedures, it's something that I think people really want to learn a little bit more about, because it is a real viable service alternative. So the next topic that we're going to talk about is ATC 206, direct examination engagements. Now, this is a new type of attestation service. It's based on a lot of the traditional protocols associated with examination engagements. So examination engagements aren't necessarily new. However, direct examination engagements are new. We're going to get into some of the distinctions as to exactly what they are and how it works. It's not often we talk about this, at a client CPE, but hopefully you'll see that this new service offering does have a lot of relevance to our clients. So if we go to the next slide, what is a direct examination engagement? So let's delve into this question. An examination engagement, as I mentioned, is not anything that's necessarily new, but the way in which a direct examination engagement is performed is different from the traditional examination engagement. So if we look at the first bullet, it's a new form of examination that allows an independent accountant to examine and opine on subject matter being the operative word. So if you look at the next bullet, what I tried to do here was to parallel an examination engagement with an audit of financial statements. Both of those kinds of engagements require the auditor to be independent. However, financial statements have an independent auditor's report, while an examination engagement has an independent accountant's report. An audit of financial statements includes an opinion that the financial statements that we're reasonably sure that the financial statements are fairly stated in accordance with an accounting framework. And usually that's GAAP, but it could be income tax basis. It might be the cash basis of accounting. It might be some other kind of a regulatory basis in all material respects. So we don't give absolute assurance on an audit of a financial statement, set of financial statements. We give reasonable assurance that there's not material misstatements in those financial statements. So if we look at an examination engagement, we're kind of doing the same thing, except we're doing it on a set of subject matter, that the subject matter is fairly stated. So I don't know how many people here play the lottery, but if you look at the lottery every night, there's usually a representative from an accounting firm there to observe the lottery. They give an examination opinion on how the lottery is functioning, and they'll say that it's fairly stated in all material respects. So that's kind of what we're talking about. It's subject matter, but it's not necessarily financial statements. That's usually an audit, or if you're doing limited assurance or review or a compilation. If you're giving an opinion on subject matter, that's different from giving an opinion on financial statements, but it's traditionally baked the same way. It's got similar protocols in the way that the engagement's conducted. So we go to the next slide. So what are some situations that lend themselves to an examination engagement, and when that engagement might be appropriate? Well, maybe an entity wants to have an opinion rendered on whether they're in compliance with an overall licensing agreement. So a lot of times, we might be retained to do what's called a royalty audit, where we're looking at a process for how royalties that are due to a party pursuant to a license agreement are being paid out, and we would give an opinion on that. Traditionally we might do an agreed upon procedure engagement on that, but under this direct examination concept, we might give more opinions related to that kind of a situation. An entity's compliance with a specific aspect of an agreement, and I mentioned the royalty audits, it could be any kind of an agreement. It might be maybe a bank doesn't want a full set of financial statements. Maybe they want an attestation engagement, examination engagement that they're in compliance with with debt covenants. That's an aspect of an agreement. Compliance with laws and regulatory requirements. Let's say the company knows that they are typically subject to a regulatory examination under some aspect of how they do business, and maybe they want us to come in and do a compliance examination that they are following all the appropriate protocols required by law or regulation. We could do that under this kind of under an attestation engagement. Specific assessments on company data and practices. Maybe a company wants us to zero in on a particular aspect of their business and make a conclusion as to whether the practices that are being employed are in accordance with a set of specific criteria. So anytime a company needs to have their performance compared to a specific criteria, that's when an examination engagement makes sense. If we pop over to the next slide. So that's the tee up as to how examination engagements work. And we've had examination engagements. Let's compare how the direct examination engagement is different from the traditional attestation examination engagement. So if you look at the left side of this slide, traditional examination engagements, management of a company performs a measurement or they do an evaluation on subject matter, and they provide written assertions with respect to those measurements or those evaluations. And the accountant expresses an opinion on whether the entity's assertion is free from all material misstatement and is fairly stated in all material respects. That's the traditional way. If we look at the direct examination engagement, very, very similar. However, management doesn't have to measure or evaluate the subject matter in accordance with the criteria. They can leave that for us to do. So that kind of gives them a little bit more availability to run the shop, so to speak, and they can leave it to the accountant to evaluate or measure the subject matter independent of management. Management doesn't have to do the upfront measurements that we opine upon. We can do them ourselves and just give an opinion on them. We can express an opinion on the outcome of that measurement, and as appropriate, we can present the results in a report. So we go to the next slide. So how does this new ATC change the landscape? Well, an entity that has limited resources, maybe like a startup company, for example, they're trying to get all their processes and protocols in place and have the ability to. They don't really have time to measure and evaluate a subject matter, let alone develop assertions related to that evaluation or that measurement. Direct examinations for those kind of folks is a viable alternative because we can do it for them. They don't have to do it. What we think is going to probably happen as a result of this ATC is you're going to see more entities engaging independent accountants to do those things that need to be done in order to demonstrate to the world that they're in compliance with whether it be a law or regulation or some kind of contractual provision. Though this kind of report helps them get that done. There'll probably be less agreed upon procedure engagements because a lot of times the agreed upon procedure engagement was the alternative when management didn't necessarily have the time to do all the measurements themselves. They would come up with a set of agreed upon procedures, which didn't offer an opinion, and it still doesn't. It says that a procedure was done. It will give the results of those procedures that the accountant employed. And that's where it begins and ends. It doesn't render an opinion. It just says whether there was an exception to the procedure that was performed by the independent accountant. The new standard can be both quantitative and it can be qualitative in terms of the agreement. So for example, like let's say I think the standard itself uses the example of a daycare center, that the daycare center is in compliance with all of the provisions that particular state requires for daycare centers. You know, that's something that somebody can give an opinion on. Now, what I will say is there is a whole set of rules related to like forecasts and projections, any kind of prospective forward-looking financial statement where you're predicting the future, in terms of assumptions or the like. That's not covered by this standard. That is covered by its own set of accounting rules. So with that said, the ATT 206 is effective for reports dated on or after June 15th of 2022. However, it's really effective now. If a company wants to start using this, they certainly can. And I must say that I'm glad we had the opportunity to examine this topic. So with that, let me turn it over back to Ed.
All right, thanks, Dave. All right, to round us out, we have Jennifer Stewart, who is in our technical resource department. She's going to be talking about SAS 134 and the related SASs and SARS 25 as they review to review engagement. Take it away, Jen.
Good afternoon, everyone. Thank you so much for joining us today. My name is Jennifer Stewart. I'm an Associate Principal of Quality Control in Withum's Technical Resources Department. And today I'll be going over some key changes related to SAS 134 and related SASs, in addition to SARS 25 related to review engagements. Statements on auditing standards 134 through 141 are effective for periods ending on or after December 15th of 2021. However, Withum has adopted these standards for all audits with periods ending on or after July 1, 2021, except for ERISA engagements. Those engagements, which are under SAS 136, will be adopted for periods ending on or after December 15th of 2021. So what are the key changes for these SASs? The main changes relate to the independent auditor's report, which we'll take a look at in a minute, in addition to the communications with those charged with governance and key audit matters. We have some examples related to the independent auditor's report that we wanted to share with you. You can see here that the opinion section will be required to be presented first, followed by the basis for opinion section. The basis for opinion section has two additional sentences related to referencing the auditor's responsibility section of the report, in addition to a statement that the auditor is required to be independent of the entity and to meet other ethical responsibilities. The next section relates to management's responsibilities. You can see that there is an additional paragraph included in this section that discusses management's requirements to evaluate going concern. And lastly, the auditor's responsibilities. You can see from the highlighted areas, there is a lot of additional information included in this section. The first paragraph discusses some additional key elements, including reasonable assurance, the risk of not detecting material misstatements, in addition to the definition of a material misstatement. Next, there is a bullet point list that includes various additional information, including the auditors exercising professional judgment and maintaining professional skepticism, that the auditor designs and performs audit procedures that are responsive to the risks of material misstatement and those procedures, in addition to a conclusion on going concern. The last sentence of this section discusses the requirement for the auditor to communicate with those charged with governance. Changes to auditor communications for those charged with governance includes an additional sentence related to uncorrected misstatements or matters underlying those uncorrected misstatements. It says that those misstatements may be immaterial in the current year, but may be material in the future. Some other additions to communications, if they're applicable, include a section on significant unusual transactions, the addition of difficult or contentious matters for which the auditor consulted outside the engagement team, in addition to a section on key audit matters. So what are key audit matters? Or CAMs with a K. CAMs include matters that are communicated to those charged with governance and are the most significant in the current year audit of the financial statements. They are not required to be performed by the auditor, and if they are engaged to report on CAMs, this must be done in the engagement letter. There is no separate opinion on CAMs. However, a description of each CAM will be included in the auditor's report. So let's take a look. This is just an example of what a key audit matter section will look like in the auditor's report for your reference. Lastly, a brief update on SARS 25. This standard is effective for engagements performed for periods ending on or after December 15th of 2021, with early implementation permitted. Some of the key changes include an additional sentence in the accountant's responsibility section of the report related to independence and ethical responsibilities, very similar to the inclusion in SAS 134 related to the auditor's opinion, in addition to the modification of the conclusion in the review report related to an adverse conclusion when the accountant makes the determination that the financial statements are materially misstated. You can see here the addition of the sentence related to the auditor's requirement, or in this case, the accountant's requirement to be independent of the entity. And lastly, an example of an adverse conclusion and a basis.
Well, thanks, Jen. I think this was a pretty good overview of new gap and gas pronouncements that are out there. And I think having individuals focus on particular topics really added some variety. So I'm not going to say it's the Ed Sullivan Show, and I am kind of dating myself, but maybe it's Donnie and Marie. I don't know, without the music. And I guess I'm still dating myself. So I'm getting old, Ed. What can I say? Any closing thoughts?
No, I just want to thank everybody for attending. You can see our bios here on the slide. So if there's any questions, feel free to reach out to either one of us or any of the other presenters who presented. But again, we appreciate you attending, and thank you for your time.